Okay, so if you've glanced at the news at all today, February 13th, 2026, you've seen it. Just a sea of red. The stock market took a huge dive, and the headlines are absolutely buzzing. This is one of those days that gets everyone talking, whether you're a seasoned trader or just someone who casually keeps an eye on things.
And of course, that leads to the one big question on everyone's mind. What in the world just happened, right? Why this sudden, really sharp sell-off that feels like it came out of nowhere? Well, let's get into it.
You know, the funny thing is, the short answer is, there really isn't one. This wasn't caused by a single thing. Not at all. What we saw today was basically a perfect storm. A whole bunch of different pressures, some global, some right here at home, that all decided to hit at the exact same time.
So, how are we going to unpack this storm? Well, first, we'll look at the global pressures that kind of set the stage. Then, we'll zoom in on the specific economic triggers here at home. After that, we'll talk about how all this flipped investor sentiment on its head. And finally, we'll get into what the experts are saying you should do now. All right, let's kick things off with the big picture. This whole thing didn't actually start here. The first rumbles, the first signs of trouble, came from overseas. We got these negative signals from international markets that created what's called a risk-off environment. And that's just a way of saying everyone got nervous and started wanting to sell instead of buy, right from the moment the market opened. So there were really three big global problems brewing. First off, you had weak signals from the major global markets. Think the Dow Jones, the S&P 500, and the NASDAQ. They were already looking shaky. On top of that, people were getting really worried about sluggish economic growth in places like China and Europe. And when that happens, it puts a ton of pressure on emerging markets like India. Okay, so the second issue was rising geopolitical tensions, which started messing with key trade routes. And what happens when trade routes get disrupted? Well, that leads to number three, a big spike in crude oil prices. Now, for a country like India that imports a lot of its oil, that is a huge deal. It immediately sparks fears of higher inflation, and it directly hits the profits of companies in aviation, transportation, even paint companies feel the squeeze. So you can see the global stage was already set for a bad day. But then, those international problems got supercharged by a few things happening right here at home. And that's what really poured gasoline on the fire. Okay, this is a classic market dynamic, and the seesaw analogy is perfect for it. Just picture it. On one side, you have stocks, and on the other, you have bonds. What happened was, bond yield started climbing. The 10-year Indian bond yield actually hit a multi-month high. When that happens, bonds suddenly look way more attractive, right? They're safer. So investors start pulling their money out of the riskier side, stocks, and putting it into bonds. And just like a seesaw, the stock side goes down. But wait, there's more. That wasn't the only problem at home. We also had a bunch of major companies, especially in IT and metals, come out with pretty disappointing earnings reports. And they weren't too optimistic about the future either. Tech stocks in particular got hammered because they're super sensitive to fears about interest rates. And then, the cherry on top, the rupee got weaker against the dollar. That makes everything we import more expensive, and it really spooks foreign investors. So let's recap. You've got all these negative signs piling up, right? Global problems, domestic problems, but numbers on a screen are just numbers until they start to change how people feel. And that's exactly what happened today. All of those factors smashed together and caused this massive shift in market psychology. It's like fear just grabbed the steering wheel and took over. And we're not just talking about a general vibe of nervousness here. No. This anxiety, you could actually measure it. It became a real number that analysts watch like a hawk, especially when things get tense. It's called the volatility index, but pretty much everyone knows it by its nickname, the fear gauge. And yeah, you guessed it. Today, that gauge shot straight up. It's the perfect snapshot of that change in mindset. When you see a spike like that, it means traders are buckling up for some wild swings, and their willingness to take on any kind of risk has just, poof, vanished. So how does this fear turn into an actual market drop? Well, it happens in stages. First, you have investors who've been enjoying these record highs, and they decide, okay, time to cash out and lock in my profits. So they start selling. But then, the big fish jump in. We're talking about foreign institutional investors, or FIIs. These are huge overseas funds, and they became net sellers, meaning they were dumping way more stock than they were buying. When others see that happening, domestic institutions get nervous and start selling too, just to manage their own risk. And that creates this domino effect that just accelerates the whole thing downwards. So there you have it. That's the perfect storm. You've got global headwinds, domestic triggers, and then a total flip in sentiment. It's definitely a lot to process. So the big question now is, what do we do about it? Let's turn to what the experts are recommending.
Okay, the first thing, and honestly, the most important thing to hear right now, is that we need to reframe how we look at this. The general agreement among analysts is that corrections like this, they're actually normal. You could even say they're healthy for the market. They're usually just temporary dips inside of a much bigger long-term growth story.
So, keeping that long-term view in mind, the experts are suggesting 4 pretty clear steps. Number 1, and this is the big one, avoid panic selling. Just don't. Number 2, focus on the fundamentals. Look at good, solid companies because those are the ones that usually bounce back the quickest. 3, try to see this dip as a potential opportunity, a chance to buy into some of those quality stocks while they're on sale. And finally, number 4, make sure your portfolio is diversified. That's always your best defense for managing risk. And that really brings us to the final big question you have to ask yourself. A day like today, it feels pretty scary, no doubt, but it forces you to think about your own perspective. For a long-term investor, is a market correction like this a crisis you should run from, or is it actually an opportunity in disguise? How you answer that is probably going to define your entire strategy long after the headlines from today are gone.